Now, shares of Disney are lower ahead of its results after the bell by about 2%, one of the worst names in the Dow today, but it has beaten estimates 14 times in the past 5 years. Will today be number 15? Julia Boorstin here to maybe answer that. Hi, Julia.
Hi, Kelly. That's right. Well, Disney doesn't give official earnings guidance, but investors are hoping for a number of updates from CEO Bob Iger, particularly on the impact of his cost-cutting moves and the progress that he's made so far towards the $5.5 billion savings target, which he announced last quarter. Now, the company is expected to show 7.5% higher revenue, while earnings per share are projected to decline by nearly 14%. Now, this is for Disney's fiscal second quarter. Now, one key factor investors will be watching is whether costs around the streaming division are declining, while streaming subscribers they hope will continue to grow. Now, as for the future, investors are going to be looking for insight into Iger's perspective around general entertainment. Of course, that impacts what he's going to be doing with Hulu, which is a deal they have to figure out with CNBC's parent company Comcast before the end of this year. The other big topic that everyone in Hollywood is talking about right now is the writers' strike. The question, of course, is how much that strike could impact the company's business, the TV business in particular. And then the other question is the economy. How much concerns about an ad slowdown are going to be impacting both the streaming revenue in terms of advertising, as well as, of course, all that ad revenue that comes in for the TV business.
You know, Julia, one of the big kind of debates or discussions I heard Disney investors having recently was whether the company is and should be all in on streaming and trying to compete with Netflix. You know, at some point, should they just say, Netflix, you've built what you have. We're going to license our content to you, reap a ton of money, and not try to build out, you know, a real rival to that. I know it sounds crazy to say, but
the ship has sailed.
Where is Bob Iger's mind?
Kelly.
Where's Bob Iger on
That
this?
ship has sailed. You know, there are so many subscribers, millions and millions upon millions of subscribers for Disney Plus. So that ship has definitely sailed. I think the question really is not whether they should invest fully in streaming, because I think they are certainly invested fully in streaming. I think the question is how much they want to compete with the likes of Netflix with general entertainment, how committed they are to Hulu. It's interesting because they're going to have a new reporting structure before the end of their fiscal year in which it's going to be ESPN, entertainment, and then parks and resorts and consumer products. So they're really lumping the entertainment business together. So we'll see what the long-term vision is for ESPN and when they want to bring more of that ESPN content onto streaming. But the real question for streaming is not whether or not they have a very successful product in Disney Plus. They have that down. The question is whether or not they're going to want to buy out the remainder of the Hulu stake that they don't currently own, and they're really going to go up against Netflix with that general entertainment piece, or whether they're more focused on just their core audience, that core Disney brand, and all those franchises they've invested so much in.
Absolutely.
So I think I'll think about it more as a general entertainment play, rather than do they care about streaming. We know they care about streaming.
I'm just saying, some of these shareholders, like, imagine how well they do if they weren't trying, you know, they could just give the content to Netflix. Anyway, we'll see if Bob Iger kind of doubles down this afternoon. Julia, for now, thank you very much. We appreciate it, Julia Boorstin.